Welcome to our managerial economics revision for exams. So we're going to cover a number of questions relating to possible exam questions. So we'll start first of all by discussing a few theoretical questions. Usually an exam paper must have calculations and theories. So some of the theoretical questions we have are to explain what break-even analysis is. So break-even analysis basically is simply the level at which output or sales are required to cover the costs. It is actually the point at which we make a zero profit. Break-even output actually occurs when the total revenue is equal to the total cost. Operating leverage. Operating leverage simply measures the ability that a business has to increase its operating income by increasing the sales revenue. So this, we have a key topic we're going to look at under the degree of operating leverage or risk and return, where we're going to calculate the output that a firm must produce in order to break even. A short-run cost function simply shows the relationship that exists between the costs and the output. It also depicts the costs that are incurred in producing different quantities of output. And we also have what we call elasticity of production, which simply measures the percentage change in production resulting from a percentage change in the quantity of an input that could be used in production. It can be labor or capital. An expansion path is simply a graphical representation that shows the least cost combination of inputs as the level of input expenditure increases. So it shows you a bundle of combinations of labor and capital that will give you the least cost combination. So we also have what we call least cost input criteria. This one occurs on an isoquant. What is an isoquant? An isoquant is simply a line or a curve or a graph combining both labor and capital to produce a certain level of output. So when we're dealing with the least cost input criterion, it actually occurs on the isoquant, where it is tangent to the isocost curve, indicating the least cost combination of inputs. Economies of scale simply refers to the reduction of the total cost, which is achieved by increasing production, which is often due to factors like specialization and bulk purchasing. So economies of scale are usually earned by firms that have reached a certain level where they're able to efficiently produce more goods at a very low cost. And returns to scale simply describes the rate at which inputs change with all, output changes with all inputs by the same factor. So we have three returns to scale. We have what we call the constant, the increasing, the decreasing returns to scale. Now these ones, sometimes we'll be asked to use a graphical representation and explanation. So like I explained, to say under production, we have what we call isoquants. Now isoquants show levels of production when we combine both labor and capital inputs. We can have labor, capital. Then we will be asked to explain how the returns to scale operates. So if you have 10Q as our first isoquant, and we have 20Q as our second isoquant, and we have 30Q. So we can see that production is increasing at a constant rate, at a scalar rate. So this we call constant returns to scale. We also have a phenomenon where we're going to be doubling our output in such a manner, 10, 20, 40. So here, production is actually increasing. So we call this increasing returns to scale. Then sometimes increase the production, but at a decreasing rate, for instance, 10, 20, 25. So you can see that the difference here is increasing. the output is increasing. However, the increase is at a decreasing rate. So you can see here from 10 to 20, there's a margin of 10. Then from 20 to 25, there's a margin of 5. Then perhaps it may even go to 25 to 28. It's decreasing as you increase. So this is what we call the decreasing returns to scale. So these are the three that we usually have. So graphically, you may be asked to draw and explain. Are we together so far?
Yes, there is a time where I stopped actually getting you. So thinking maybe it was at my end.
Pardon?
I'm saying there is a time that I wasn't getting you.
Oh, okay.
Maybe you can just go through a bit.
All right, so I was explaining that the returns to scale, besides understanding the definition that I'm talking about, come in three phases. We have figure 1, figure 2, figure 3, and figure 3 like that. So to explain the returns to scale, it simply gives us a picture of how if when we combine the labor and capital, they'll give us certain levels of output. So here we have 10, 20, 30. So in this figure here, you are seeing that the output is increasing at a constant rate. We're just increasing by 10 throughout. But in figure 2, it's increasing from 10 to 20, 20 to 40, 40 maybe to 80, it's doubling. So we call this an increasing returns to scale, because when we combine labor and capital, we're going to have a scenario where production will increase. Now, in an output scenario, when we have our labor and capital, and when we add the two coefficients, the alpha and the beta, and when these ones are equating to 1, this is the result of our constant returns to scale. It simply means what you put in is what you reap in production. So there are certain instances where the same function, we have our alpha and beta, and when we add these ones, we're going to get a figure more than 1. So this is called increasing returns to scale. Increasing returns to scale. Any questions so far?
No, we are way to go. Can you hear us?
Yes, I can hear you. Are we clear so far?
Yes.
So if our alpha and beta, when we add them, is greater than 1, this is called increasing returns to scale. Lastly, so for increasing returns to scale, it simply means if you're going to invest maybe 10 million in your labor and output and capital, the answer that we're going to get, if it's more than 1, or it's more than how much you put in. If you put in a 10,000 and you're getting 20,000, that's increasing returns to scale. But if you put in a 10,000, you're getting a 10,000, it's just a constant returns to scale. However, if you're not efficient with your input combinations, you discover that when we add input alpha and beta, and we're getting a figure less than 1, this is called decreasing returns to scale. So this is the scenario or phenomenon that happens when we have inefficiencies. So these are the 3 returns to scale that you must be alive to. All right. So I was just trying to explain property number 8. And we also have what we call the marginal resource cost. This is just a wage. It is an additional cost that is incurred each time we add a new input in the production process. Now, production is predominantly what your exam questions will have. Most of the questions are on production. So production, you must understand that the total product is the same as the Q. So when you divide the total product of labor divided by the labor units, what we get is called what? Our average product of labor. When we multiply the average product of labor times the labor units, what we get? We get the total product of labor. When we find the change in total product of labor over the change in labor units. What we get is called the marginal product of labor. These are incremental. All right. Then if you're given a price in the market and you multiply it by the marginal product of labor, what we get is called the marginal revenue product. The wage is the same as marginal resource cost, or the change in our total cost is called the marginal resource cost. So our key is always to ensure that we do what? We employ laborers that are giving us more revenue than our cost. So I'll give you a hypothetical scenario. For instance, you have 10 laborers, and each laborer is giving you an average product of what labor of 1,000. So what is the total product of labor for these 10 laborers? It is 10 times the average of 1,000 to get 10,000. So 10,000 is how much all these 10 people are producing. So one person wants to add an additional input. For instance, here, want to bring an additional input of 12,000 units. That's one person. So additional means what? Marginal product. So if you have marginal product of labor for one additional person, so meaning the total number of laborers, we have one additional person plus the 10 that we had initially. So how many laborers we have in total? We have 11 laborers. Then we have our total product of labor that we have now for the 11. We just combine what we had for the 10 laborers plus what we have for the additional. Additional means what? Marginal product. So we had initially 10,000. Then we have added what this person alone is bringing, 12,000. So our total product of labor now is 22,000. So this is the total product for 11 laborers. Now, what is the average, the new average for the 11? So remember the formula for average product of labor is simply the total product of labor divided by what? The number of laborers. So here we have the total for the 11 is what? 22,000. And how many are they? And now 11. So when you divide in there, 11 into 22, what do we get? 2,000. So when this new laborer comes in, he will increase our average product to 2,000. This is for the 11 people. Are we together so far?
Yes.
Now, this person who has come, we are told that the market price for each unit is 2 kwacha and is asking to be paid 25,000 kwacha. So can we employ him? So we need to calculate our marginal resource costs. So we know that our marginal revenue product is simply the marginal product times the market price. So he's bringing in 12,000 units, and each unit is how much? 2 kwacha. So the value of his 12,000 units is 24,000 kwacha. And how much is he asking for? He's asking for a wage of 25,000. So our rule is we only consider deploying a person if the marginal revenue product is greater or equal to the wage. So if we compare how much is bringing, 24,000, and how much is asking for, 25,000. Is it economical? No. So it is not what? Not worth it. Are we together?
Yes, we're together.
Okay. So now I usually build from small principles to big exam type questions that you are able to understand. So Let me go to an exam question built on the principles I've just explained now. So there will be just some slight ingredient that we added for us to understand it better. So let's look at question number. Let's look at question number. Let's look at question number 45. Okay. Question number 45. In question number 45, what are we told? We're told that ABC is operating at an average product of 1,000 with its current 10 workers, and considering employing an additional worker who has an additional 900 units. So what will be the company's average when the worker is taken on, assuming the price per unit is 2 kwacha, should the worker be taken on at 1,700? So what are we given in here? What are we given? Number of laborers, how many are they?
There are 10.
10. The average product of labor is how much?
1,000.
1,000. Therefore, the total product of labor for the 10 is how much? 10 times 1,000, which is what? 10,000. Are we together?
Yes.
Okay, so this person who wants to join wants to bring additional 900 units. So this addition is called the marginal what? Product of labor over 900. So what is the total product? If this one is taken on for the 11, it's 10,000 what? 900, right? So question 1, should we take on this person? What is the new average? So it's a total product of labor over what? The number of laborers. So 10,900 divided by how many number of laborers we have? 11. Right together. So what is the new average? We simply divide 10,900 divided by what? 11. So we get 990.91. So this is part 1. Part 2, assuming the market price is 2 kwacha, should we employ at a wage of 1,700? So our rule is the marginal revenue product must be greater than the wage. How do we get the marginal revenue product? Who remembers? It's the marginal product times what? Times the price. So he's bringing in 900 additional units times 2 kwacha. This should be more than what? The 1,700. So in this case, what is the value, net worth value of his products? 1,800. And how much is he asking for? 1,700. Is it worth employing? Yes. Are we together? Are we together?
Maybe you can repeat on B.
Pardon?
Maybe you can repeat B. I'm a bit behind because I was copying what you're writing.
Okay. So on B, we're being asked, assuming the price of the product is 2 kwacha. So how many units is he bringing? 900. So the price for this 900 is simply what we call the marginal revenue product. Are we together? So this 900, we want to convert it into kwacha. So we multiply this 900 units times 2 kwacha. So the value of the 900 units is 1,800 kwacha. So should we employ him? We need to know how much he's asking for. He's asking for 1,700. So if how much he's bringing and how much he's asking for, if he's bringing in more than what he's asking for, we should what? Employ him. So in this case, he's employable because we have a marginal benefit of 100 kwacha, because what he's bringing in is 1,800. Is that clear now? Okay, let's look at another question here, number 52. We're given the labor units here, the marginal product of labor, the marginal revenue, and the marginal resource cost. And we're asked what is the profit maximizing level of employment. So we know that the marginal revenue is simply the price, and the marginal product of labor is the MPL. So we need to know how many units we need to employ. So we know that employability must occur when the marginal revenue product is equal to or greater than marginal resource cost. So we need to come up with another column for the marginal revenue product. We multiply the marginal product times the marginal revenue to get the marginal revenue product. So 40 times 4 times 10 is 40. 3 times 10 is 30. 2 times 10 is 20. 1 times 10 is 10. 0 times 10 is 0. So we only employ when we are making more than we are spending. So 40 is more than 20, so this is okay. 30 is more than 20, this is okay. 20 is equal to 20, here we stop. 10 is less than 20, here we can't employ because we're making a loss. Here, we can't employ. So what is the profit maximizing level of employment? We look at the point where marginal resource cost and marginal revenue are equal. So how many employees are we going to look at? 3.5 employees. So this is the output where we're going to maximize our production. Are we together?
Yes.
Right. Now, let's go to slightly tough question. Just on this table in production, we look at how Dr. Musawa coined it. So this question to do with operating hours. And the lady was okay, I sent the question yesterday. Here, question number 3. So Mrs. Banda is an owner of a fine duplicating service which is located at Monash University, and she is contemplating keeping her shop open after 5 p.m. until midnight. In order to do so, she will have to hire additional workers. She estimates that the additional workers will generate the following total output. So where each unit refers to 100 pages. So workers had 0 up to 6, total product 0, 12, 22, and that one. So we want to know if the price is $10 and each worker is hired and must be paid 40 per day. How many workers should she hire? 10 max. So let's look at the number of laborers. We have 0 up to 6. The total product, we have 0, 12, 22, 30, up to 42. Are we together with this part that we've been given so far? We're just coining it in the production table. Are we together so far? Then the marginal product is the addition from here to here, 12. From 12 to 22, 10. From 10 to 30, 8. 30 to 36, 6. 36 to 40, 4. And 40 to 42, 10. So these are additional products. So we call this a marginal product. Then the price, we've been told that it is 10 kwacha. So we put 10, 10, 10 throughout. So remember, when you multiply the marginal product and the price, what we get is a marginal revenue product. So 12 times 10 is 120. 10 times 10 is 100. 8 times 10 is 8. 6 times 10 is 6. 4 times 10 is 40. And 2 times 10 is 20. Then we are told that she expects to pay each worker $40 per day. So this marginal resource cost, you put 40, 40, 40. So you need to look at a point where the marginal revenue product should be equal to the marginal resource cost. So here we can employ it more. Here we're okay, here we're okay, here we're okay, here we stop. Here we make a loss. So how many employees must she consider? She must consider 5 employees. So this is the point where we must stop. So 5 workers are tenable. Is it making sense?
Yes.
All right. So find the marginal revenue product of the labor for the data above and show the number of workers that Mrs. Banda should hire obtained above in A. So we have done that already in the table. Okay. So this part 2. Suppose the marginal product of the last worker employed by a firm in 40 units of output per day and daily wage is $20, while the marginal product of the last machine rented is 120 of output per day, and the daily rental price of the machine is $30. Why is the firm not optimizing or minimizing costs in the long run? How can the firm maximize or minimize costs, maximize output or minimize costs? So what are we given in this? We need to understand the data and tabulate it properly. So suppose a firm has a marginal product of 40. So marginal product is what? Of labor is 40. What else are given? The wage is what? 20. Then we're also told that the marginal product for the last machine rented, marginal product for last machine rented was what? 120. And the rental was how much? The rent was how much? 30. So you must understand that optimization bundle occurs when marginal, this is marginal product of capital, marginal product of labor, we divided by the wage, must be equal to marginal product of what? Capital, divided by the rent. For us to be optimal, these must be the same. So here, what was the marginal product of labor? Our marginal product of labor for the last worker employed was 40. So you put 40 there. And their wage which was paid was 20. So 20 there. So 20 into 40, what we get? We get a 2. And when we go to capital, we are told that the marginal product of capital was 120. Then our rental was what? 30. And divide that, we're going to get a 4. So these two are not the same. So the firm is not maximizing. Is the firm maximizing? No, it's not maximizing or minimizing costs. Why? Because 40 of output divided by 20, we're going to get a 2. Which is not the same as the 120 a day divided by the rental of 30. So the firm in this case is not what? Utilizing labor and capital optimally. This means that it can increase output or decrease cost by adjusting the mix. So how do we adjust the mix? So the firm should adjust the mix in a way that the two ratios must be equal, either by hiring more workers or renting fewer machines, since the marginal product of labor per dollar is higher. So this is either of the two. So here we should have higher, less rental. For instance, instead of hiring at 120, we find something higher at what? 60. Such that if 30 into 60, we're going to get a 2, which is the same as the 2 that we're getting. Or we hire more laborers. We have to get a 4, we would have 80 there. So we should spend 80 there. So 20 into 80, we get a 4. Are you getting that narration? It's very important because most people don't understand. In economics, you cannot guess. You don't know, you don't know. So it's the principles of optimization that are important. Are we together?
Yes, we are together.
Okay. So this is a very key principle I really needed you to understand. So we go to Something else? We'll look at cost theory. Now we're told that Mr. Kelvin is a lawyer who's working for a huge firm and is earning $60,000 per year. And contemplating on setting up his own law practice, he estimates that renting an office would cost $10,000, legal secretary $20,000, that's already $30,000. Renting office equipment $15,000, that is already $45,000. Purchasing the required supplies and paying for electricity, telephone, and so on, which will cost another $5,000, that is $50,000. So the lawyer also has estimated that the total resources for the year would be $100,000. He is indifferent between keeping his present occupation with opening his new law firm. So now we need to compute two things: what we call accounting costs and economic costs. So what are accounting costs? Accounting costs are simply explicit costs, which are direct costs that are incurred in organizing something. So we need to differentiate between accounting costs and economic costs. So what's the difference in your own language between the two? What are accounting costs and what are economic costs? There's a word I'm looking for. What are accounting costs and what are economic costs? One is out of pocket. It's very important as economists to understand the two and differentiate them for you to be able to compute what we are trying to compute here. I think that's where the key exam question is. Mr. Chimka, would you want to try? So accounting costs, yes?
You said an accounting cost and an economic cost, huh?
Yes.
When you're watching the Jesus film.
I'm some kind of lost a bit. Okay.
So accounting costs are also called explicit costs. This is the actual money expense that a firm incurs or an individual. And these ones are incurred when we are conducting business operations. These costs are usually recorded. They're actually recorded in the financial statements, like the income statement, the balance sheet, the cash flow statements, accounting costs. Then also they include factors of production like wages, rental, material costs, etc. All these encompass what we call accounting costs. Okay. So accounting costs are very straightforward to calculate. They're usually based on the cash outflows. So they usually help us provide a firm's financial performance, and they also help us really gauge our profitability. Economic costs are implicit costs, which go beyond our explicit money or out-of-pocket money. They also take into account what we call opportunity cost. And we know by now opportunity cost is simply the value of the best alternative foregone. So economic costs will encompass explicit costs. So accounting costs are found in the economic costs. So in simple words, economic costs are simply accounting costs plus opportunity cost. I don't know whether you got me right. Did you hear what I said?
Yes.
So the calculations I'm going to do now
Yes, yes.
are going to be based on that explanation. Let me just beam the explanation for your own digestion. Okay. So these ones are very important. So accounting costs are explicit costs, are out-of-pocket costs, whereas economic costs are referred to implicit costs. The other name for economic costs are implicit costs. So these ones take into account opportunity costs. When I'm looking at accounting costs, they would look at values that we actually paid for, like rent, raw materials. So we want to calculate Mr. Kelvin's accounting and economic costs in this equation. So the accounting costs are direct costs. So we're going to calculate the rental which he paid for the office, hiring costs, the rental for the equipment, the cost of supplies and utilities. So the total is coming to about what? 50,000. So this is what we call the accounting cost. Now, he usually was getting what? 60,000. That is implied. So we want to calculate the what? The economic costs. So the lawyer's implicit cost will simply be 60,000, which is opportunity cost for his salary at a law firm. So when we are going to calculate that, so we're going to add everything added there, then we add the cost of him being a what? A lawyer at that very firm. So the cost that he's going to incur is what? 110. So is that clear? So when
Yeah, we are very clear.
when you are an economist and you're renting an apartment, you'll charge for that apartment under accounting costs for rentals, for instance, 2,000. But if you're an accountant and those are premises are yours, as an accountant for the accounting profit, you'll not charge rent if you're not paying rent. But an economist is not agreeable. Says no. We're going to assume we're renting this particular property. So under economic profits, they will charge for the promise as if they were hiring. So this is how it is done. So this is why we are adding the cost of him being a lawyer. And it's very important. If you're running your own firm, you need to predetermine the value. If you're a director of that firm, put a salary there so that you give yourself a salary as if you outsource services of your own self. So that is what this concept was trying to bring across. Okay. So I hope this has been clarified.